So just for the record, this is being live streamed. So can they see us?
There's right now, I don't know how Mike has it set, but yes, they can.
Okay, so we can be seen and be heard.
Perfect. All right, we'll start with our public comments. Vice Mayor, you have anything?
No, sir.
All right, on to our new business. We have the experience study decision.
So that was just brought up from last meeting where Doug pitched it, but that's something.
Put your mics.
So the experience study was a follow-up from last meeting when Doug was here, your plan actuary, and he explained that we do the experience study in general every 5 years. It's time, we're past the 5 years, and so he pitched it to you last time and explained it, the relevance of it and why he does it. And it was asked to table it so that you guys could kind of think about it, I guess, a little bit more. So he's not here, obviously, again, but he did want me to bring it up and just get a yes or no. If you do, then we just make a motion, and then Doug prepares it. And if not, he just wants me to just let him know the reason and if it's something you're going to consider in the future. So
the experience studies are recommended because they true up the actuarial valuation to the assumptions used in the actuarial evaluation to what's actually happening on the ground, right? So you make guesses about what you're going to earn. You make guesses about different things, how much raises are going to be, and then what every 5 years, if he gathers all of the data that happened since the last experience study, he can see, are these assumptions correct? Do we need to tweak them in some way, or can we just continue on with those valuations? So it's good to kind of bring the valuation closer and closer to reality.
Right, so we had two that weren't here, and correct me if I'm wrong, but it was my understanding that we basically had two options, one to keep it the same, or we needed to vote to go with the recommendation of lowering the assumed rate of return.
So part of that was the assumed rate of return, but in the experience study does more than that. So it used to measure your mortality table, but the state mandates the mortality table, which you will have a mortality table change this year. So you look at the interest rate, you look at salaries, you look at retirement patterns, you look at the number of disabilities that you've had, or in this case not had, and so he'll look at then the assumptions that he's making in the valuation, and again make recommendations to you about how to tweak those assumptions to make them match what's happening on the ground, or come closer to what's happening on the ground. I mean, you can't be right, but you can be close. So that's what he's asking for, is the opportunity to go back. He'll gather the data since the last time he did an experience study. He'll gather the data of the members, how many retirements there have been, what the raises have been over time, and you put that into his tables. And then come to you with a recommendation about what to change and how much it costs to make those particular changes.
Okay, so the presentation that he gave last time, that was not the current experience study.
That's just talking to you about the experience study, asking for your approval for to do it.
I see. So he just needs a yes or no on whether or not to conduct.
That's correct.
That's correct.
That's correct.
And of the 18 plans I have, we do this on every one of my plans. So it's every 5 years, one board waited for another year. I think you guys are 6 or 8 months past the regular 5 months, or 5 years. But so it's something, it's for the board as far as managing this, but it's also for the town and what their contribution rate is later. So wanting to get it as close as we can is going to help both the board and the town.
Right. Is there anybody that has any questions or want to make any statements before we make a motion for the experience study?
The rate of return assumption, was that introduced in this study?
That would be part of
right?
it as well, yes.
So he talked about it, but it doesn't sound like he's asking us to make a decision about that, but he did bring that up
Correct,
as part
yeah,
of it, and so it sounds like there will
Yeah.
be some more tweaking.
Correct. I wouldn't discuss the mortality or the assumption rate with you. That would be a Doug thing.
Right.
Yep, that's not something I would.
That's why I thought he was going to be here because I thought we had to make a vote on that or make a determination on that.
So that discussion would be concurrent with his study.
Right, he would come back and present it, and at that time is when you would make the determination about the assumption rate. So once he brings you back all the numbers, he gives you everything and explains to you and gives you a few options. Usually that's what it is, like an A, B, or C, and the board would then vote on which one, stay the same, and for this reason, move to this for this reason. So that's what it would be, is that the following quarter, he would be here to present the experience study.
So that would be the next meeting.
Correct.
I think we tabled it too because the raises were pending October 1st. We were still discussing the 175, 185 money. So
That
he
could have
wouldn't have
been
had,
part of it as
I think
well.
that was part of it because
And then we
everything
had-
might have changed or might not have changed and it actually did change. So in order for him to have the,
So here's the outcome. Discuss the summary page, which showed the fund ratio. Tracy was comfortable with the current 6.75% assumption rate. You voted to, no, you were at the point of making the decision on what your interest rate should be. So 6.75 he's comfortable with, and he asked you all to decide which option you would choose.
Right, so he did ask us to do a vote on whether or not to change the assumed rate of return or leave it the same.
No.
And part of the experience study, right, it tells you the dollar impact of any change that you make, whether it's to salary increases, terminations, or the return assumption, right? So that was part of the discussion was, well, let's see what the numbers are as well to make the determination on all of this.
So is he asking whether we should change the assumed rate of return? Or
No,
can
he
he
wants to
change the assumed rate of return for the study
Yeah,
and
so
then come at the back end of the study?
Scenarios, right?
Right.
It'll say, if we change it to 6.5, here's the dollar impact of that. And along with all the other assumptions, right? So that it kind of gives you the impact of any changes that he's proposing or potentially, ones you to consider.
Right, I thought he showed us those changes.
he did.
Yeah, he did.
Hang on, I'm gonna pull it up.
There was like 5 different criteria, and then he showed if we left it the same, what the percentage difference would be for the town, for the employees, and then if we lowered the assumed rate of return.
Get onto my server. Sorry, our servers have so much security on them that trying to connect from an air card is very difficult sometimes. It's over a minute when I'm on Wi-Fi, so on an air card, it's a little more difficult. Okay, I think I might be in
When was the last time we did the 5-year review?
So he did do the 5-year review, so it was listed here wrong on the agenda, but he did do it, and so ultimately, he's just asking you to decide.
My bad.
He
And
did.
that's,
It's true.
I'm
It's
looking.
July.
Yeah, we did approve it.
Yes.
Yeah, that's
Right,
my
because
bad.
we didn't want to take a vote because not everybody was here, so we just,
I just found it. Okay, yeah, that's true.
The question should be if the gentlemen that weren't here, have they had a chance to review the information? Because why would we take a vote on something that everybody hasn't had a chance to
And I'm
review?
gonna guess not.
So I would say, my suggestion would be we just table this again to the next
Sure,
meeting.
You can, that's the best idea, I would think.
Well,
I could send back out the experience study to you and, if you didn't get it for the first time.
so Doug should be here,
Okay.
right?
No.
Doug should be here at the next,
For the valuation.
with the valuation.
Right. So
And
what I'll
be
do
able
is,
to then discuss the
In person.
experience study and applying this either to he's not a fan of changing the one he's already done, but, or, you know, changing it going forward.
So what I'll do is, I'm gonna check with Doug to make sure that his schedule works for the next quarter. And if the valuation is ready to, or if not, either way, I'll just let him know that the board's requested that now that we have a full, hopefully we'll have a full board the next time as well, that he can show up and hopefully get this, you know, to where everybody feels comfortable and you guys can make a vote, you know, make a motion.
Tom, did you get a chance to see that study from the last one that he had put out okay.
I'll send it back out again, just so that you have it.
So do we need a motion?
I'm going to make a motion to table it to the next meeting, please.
I'll second that motion.
All right, motion second, all in favor?
Aye.
Aye. Tabled. All right, we've got the approval of the minutes from our last quarterly meeting. Do we have a motion to approve the previous minutes?
I'll make that motion to approve.
All right, second?
I'll second it.
All right, all in favor?
Aye.
Approved. All right, moving on to our old business. I don't have anything listed here in old business. Anything else we need to discuss from the front there? All right, moving on to our reports. We've got from Mariner Institutional, Mr. Brad Hest, our investment consultant, going over our quarterly report and follow up on the real estate presentation.
Yes. So I have those two items. I also have a global bond manager. We talked about that last meeting. So I have some funds that have been vetted by our research team for you to consider there as well. And then also a small update to our investment policy statement given some state, a statute that was passed in July. And in consultation with Bonnie and her team, we think it's prudent to add some language just to continue to protect the board that we're abiding by state law. So I'll get to all of that. But let's jump into the quarterly report. Good report, good close to our fiscal year. If you flip to page 3. So if you remember, the first two fiscal quarters were kind of iffy, a little bit negative. And then the quarter ending June 30th was really good as we had a tremendous bounce back after the initial rough patch due to the initial tariff announcements in the beginning of April. But it ended up being a really strong quarter, and that momentum continued. So you can see on page 3 on the upper right-hand side the returns for the various market indices for the quarter. S&P 500 up 8%, which is a very strong quarterly result. You can see within domestic, it was very much a risk on, and a lot of people are describing it as a momentum kind of speculative market that has happened last quarter. And part of the way that you can see that is the big outperformance of the Russell 2000, that small company stock index, up over 12%. We saw international stocks do another decent result, up about 7% for the all-country world, ex-US, in the darker orange. And that's led by, you can see the emerging markets, again, the kind of riskier area, up over 10%, almost 11% in the quarter. And then rates came down a bit, and you had a positive result for your bonds, and then we'll get to another kind of 1%-ish return for the real estate fund. So everything kind of was working. Other than, we'll get into it, a little bit of active management underperformance in our growth manager, given some of the stocks they didn't own or were underweight. So the big news in the quarter was, in September, the Federal Reserve cut interest rates by 0.25%, kind of signaled they're going to do 2 more. They meet tomorrow. We'll see if it continues. There's a little bit of, speculation about, with the federal government shutting down, while we got a CPI number last week, a lot of that data hasn't been coming for the last month or so. But still, the market are kind of expecting them to cut by 0.25%. Tomorrow. We have, and the reason why they're cutting rate is inflation seems to be under control, but although not at their target, their stated target, I'll say, of 2%. We are starting to see weakness in the labor economy with unemployment going up. You're seeing, new job creation declines, revisions to data that came out as well that were negative. So it seems like we're starting to kind of have some weakness, although at 4.3% unemployment, still very low historically, but if you remember, we were like down lower than 3.5%. So I think that's kind of the balance of risks is what the Federal Reserve talks about, being more on the employment side versus the inflation side. And we just got the inflation number last week, and while it's at 3%, it was actually better than expected, as we're still seeing some impacts, although more muted than a lot of people probably anticipate for the tariffs, right? You have some price impacts of that, but it seems to be kind of, pretty much right, not impacting general price levels right now as much as I think many people would expect. So that's why the market's kind of betting that the Federal Reserve will continue to cut rates, and we'll have another cut tomorrow. Corporate profitability, we're pretty well into earnings season. I say generally speaking, it's doing good. Companies are reporting good earnings. The banks all reported earnings. One of the things I was kind of looking on the lookout for there is kind of signs of weakness in consumer behavior, and are they starting to increase the reserves for loan losses and things of that nature. And it doesn't seem like the large banks are really, they're kind of saying everything's pretty good. They're not doing meaningful step-ups in their loan reserves and write-downs, et cetera. So, but you can see 1-year performance on the lower right-hand side of almost 18%. That's if you think about 2024, 20+% return for the S&P 500, 2023, 20+%. Valuations, we talked about this last quarter, right? Valuations extended. What the kind of price earnings multiple of the S&P 500, what Wall Street expects, is very high relative to historical levels. And it's making, a lot of people, there's a lot of ink being spilled on how, we're in an extended valuation perspective for the S&P 500. People are throwing around words like bubbles. It doesn't seem bubblish to me. The earnings are still coming in. It looks like the S&P is on track for double-digit earnings growth this year, which is very, very strong. The NVIDIAs and the Teslas of the world, absolutely kind of, the valuations are very, very high with those companies. Particularly NVIDIA is just growing like gangbusters, right? Same thing with Microsoft, or trillion-dollar companies to be posting, teens type of earnings growth is pretty remarkable. We flip to page 10. You can see that's the Treasury yield curve. So what for each maturity, what the interest rates are. So you can see the red line is where we started the year. It's 12/31. So we've had a meaningful decline in interest rates, particularly on the 10-year there, where the 10-year went from 4.5, a little bit above 4.5, 4.6 to now. I know it broke below 4. I'm not sure where it's at exactly today, but we're at the 4-ish% mark right now. So we've had a pretty significant decline in interest rates, which has helped fixed income. Any questions on kind of broadly speaking what happened in the quarter for markets or the economy? Page 13 shows you the kind of longer-term view of the pension. That blue line is the market value. The gray is the net cash flows, just kind of what's in versus coming in versus going out. So you can see, obviously, almost $2 million, an all-time high for the pension, which is great in spite of kind of pretty significant net cash outflows over the last 5 years. In terms of, page 14 shows you the side-by-side of June 30th to September 30th. So we went from 19.9 million to 21.2. So a really nice quarter of gains. That's in spite of us actually doing a rebalance after last quarter. If you remember, we cut back our equities a bit and put that into fixed income, trying to be kind of risk aware. So you can see our equities actually went down from 66 to just shy of 65%. Page 17 shows you what those numbers, the asset allocation numbers, look relative to our IPS targets. So we're within our policy limits for everything. Continue to be overweight domestic equity at 65% versus that 60% target, and then a little bit underweight our non-core fixed income and our real estate. When we go through everything, we kind of talk about the global bonds as well as the real estate. I'm not going to make a rebalance recommendation now. I'll save it to see if we want to do anything with the global bonds, and then I'll make a recommendation on where we could put money if we wanted to invest in those. Page 18 shows you all the activity in the pension during the quarter. So you can see 19.9 to start. The net transfer shows you that rebalance where we sold some of our Fidelity 500 index fund and put it into the Manning Pure Fixed. We had $455,000 and some change in contributions come into the pension. We paid out $271 in benefits during the period. Management fees of $21.85, other expenses of just shy of $14,000. Then a great quarter from a gain perspective, just over $138,000 in dividends and income, and $926,000 of capital gains. So that got us to that $21.16 million mark. Fiscal year to date shows you, even though we're overweight, we've kind of, equities, we did do some meaningful rebalances during the fiscal year. You can see on page 19, we actually reduced our equity by about $1.3 million during the fiscal year. Most of that was the fund receipts and disbursements, outflows that we had. But we also added a little bit to fixed income last quarter, as you can see. Highlight that. And then returns, good quarter, page 20, net of fees, 5.3% for the quarter. Fiscal year to date, we got about 12%, so that compares very favorably relative to our return assumption. Glad to see that. Long-term results well above that return assumption, so that's good. Still have some work to do relative to our policy index, although we got a small win for the fiscal year. Given some of the changes we made over the last year, I think they're coming to fruition and starting to impact the results. So it's really good to see. You can see the managers for the quarter, so our Russell Index, Russell Value Index, you would expect. And I talked about the MFS growth. The index was up 10.5, and it was only up 5.5. Biggest things there, doesn't own Tesla, which was about 1% relative to the index. It's underweight Google, it's underweight Apple. So Apple was up 24%, they only own about 6%, it's about 12% of the index. And then they're overweight Amazon, which was flat for the quarter, so all these kind of relative value decisions that they're making kind of worked against them. So you can see where they rank relative to that peer universe, a little bit below average since we added them. The index has been so hard, you can see the index since inception, 16%, ranked 6th, so 94% of active funds have underperformed the index during that time, at least the Russell. Now, we've talked about some of the issues with that index too. It's very, very concentrated, 60% of, I think the index, or 50% is in the top 5 or 6 names, very, very concentrated. Structurally, I like having most of our money in the index, but having some in active. We only have 4 chances really to make decisions throughout the year, right? Having some money into a manager that can be a little bit more tactical and take advantage of shorter term market opportunities for a little bit of our money, I think makes sense. But at the end of the day, it's hard to keep justifying active management fees when they underperform. So I wanted to bring it up, see if you all had any thoughts on that. We've obviously made a big change to just kind of move into passive, low-cost index funds over the last 3 years. Like I said, structurally, I like having some of that, but it is, you know, if I would bet my life on it, it's hard to keep justifying active management, particularly you know, paying fees when you keep underperforming. Now, there's a lot of things that are going on under the table that you know, within, you know, we talked about the extended valuations. It's hard to time these things. So, you know, I wish I had a more definitive answer, like, yeah, you definitely should fire them, but I think there's some mitigating circumstances that gives me pause to make that recommendation to you all, if that makes sense. Any thoughts, Tom?
We have like, just like some of the numbers, I think it's like a quarter, is that what we have, a quarter in active right now? Or no, we only have a quarter in, we have a quarter, less than a quarter. Because we have the Russell 1000 value, and we index. Am I right, we've got 13.7 in equity?
Yes, and we have 11 million that's indexed.
Right.
About 9 and some change in the S&P 500 and about 2 million in the.
So was that like 80%?
Yes.
Was that what we made this decision like 2 meetings, not the past meeting, the meeting before that. So it's like 10%. 10%
Right.
would be 1.3, so 15, probably like a quarter, right? I mean, it's kind of distressing because we had, you know, T. Rowe. It just shows you how hard it is, because we had T. Rowe, and they had a really good year. You know, we got rid of them because MFS was doing well, and now MFS has screwed up all their allocations. So we kind of stayed with the winner. That's why indexing works.
Right.
You don't have to blame yourself for picking the wrong guy, wrong horse. I just looked at their allocations of it in September. It looks like they must have increased their NVIDIA, and they're like 14% in NVIDIA. Their Russell 1000 growth, Microsoft is big, Amazon is 6.5. I mean, what are they saying? Google, by the way, has just kind of come on fire ever since the DOJ decision.
Yeah.
So
So I haven't gotten their quarterly commentary yet, and I don't think our team, our research team, has done a quarterly call with them. Last I heard, I think the increase in weight for NVIDIA, I don't think they're buying NVIDIA. I think it's that market value, appreciation, based upon that. I mean, the one big thing that had just hampered them for the last 5 years, they haven't owned Tesla the entire time, right? So that's, you know, that hurt. It's a very volatile stock, as you know, right? In negative quarters, they look good because that tends to go down 40% in the blink of an eye, and then you get these periods where it doubles in, you know, 6 months. It's just a very, very volatile stock, right? So that's a big one that they missed out on.
Is our fund, does the MFS, the R6, does that have a minimum? Is that a Y share or anything like that? Or?
So the R6, so it might have a stated minimum, but because of our relationship, it doesn't really apply. We just ask for an exemption, and given our firm's relationship and the size of assets that we have, we generally get them for the, you know, particularly for our public funds. So that R6, for people that don't know, that's typically in a defined contribution. It's a share class for defined contribution plans, but we get access to it for our pension funds because of, you know, we basically ask, and most firms will give, you know, let us get into that fund for our clients because you get a small change, savings versus the institutional share class.
I guess what's a little frustrating is to see that they're like basically underperforming the S&P 500 in a growth market for the quarter.
No, just but they're doing pretty, I mean, that,
Yeah.
you look at absolute return,
Yeah.
you know, you're getting something, you're gaining something.
Yep.
So that's one way, I mean, that's kind of how I look at it, plus you've got flexibility, plus you've got, you know, per year, you're, you know, 18 and a half, and the S&P 17 and a half, so, I mean, worst comes to worst.
Yeah, for the fiscal year, you know, for trailing 1 year, you know, they're ahead.
Right.
Of kind of our stated investment objective, you know, for equity.
Yeah, so, I mean, it's,
I would just revisit this.
think that's fair.
Do we have any funds in a passive index for the growth, or is it all just in the managed?
Right now, so it kind of depends on how you view the S&P 500 now. I would argue that it's kind of a growth index, right? It's 35% is in those, growth names but like, for the actual growth index, it's like 50 or 60% in those names, right? So to answer your question, we don't have any of our dedicated growth assets index right now. It's all in the Fidelity 500. So that is an option. There's just like there's a Vanguard Russell 1000 Value Index Fund. There's a Vanguard Russell 1000 Growth Index Fund that we could also use if we wanted to. But I'll note, we talk about it every quarter, but we'll continue.
The numbers look good, though.
Page 21, just for the record, you see total fixed income eked out a small win versus our fixed income policy index, 13 basis points. So for the 1 year, a little bit under. But nothing really to kind of write home about. Manning Napier kind of, we're in a kind of conservative approach there. It's paid to take credit risk. Which you can see for the 1 year for our non-core fixed income, right? The floating rate funds are both up 7-ish% versus our core bonds were up 3.5. And then you can see what the returns on for the real estate funds on page 22. So each of them were up about 1% again. So it's kind of the same thing that we talked about last quarter and the quarter before. Last 3 quarters, we've gotten about 1% each of those quarters after that 8-quarter downturn. And the way that the returns are being generated, it's entirely generated by income. So the capital appreciation part is very, very flat still for the overall kind of commercial real estate market. And you're kind of just clipping that 1% per quarter coupon that is being generated off of those funds.
Mr. Chair,
Sir.
can I just ask a quick question of the consultant on page 22? It shows that the NCREIF index was exactly 0. Does that mean we didn't have the number?
That's right. So it's too early in the quarter to have the index number calculated. So we got the statements from the managers, but you got to wait for like 29 other funds to calculate that. So that'll change.
Okay, thank you.
Yes, but it's carried at 0 right now. Yes. Any other questions about the quarterly report?
Nice number to put in the books.
We're comfortable with the allocation. I wasn't here at the last meeting, but you guys made a decision to reallocate some equity assets to fixed income.
We did. So we did a 2% reduction
Right.
and put that money into the Manning Napier because, we were at 66. At that time of the meeting, we were probably closer to 67%. And
our target,
I always view kind of the 5% plus or minus as kind of once I get over 5% overweight, it's like, okay, let's start talking about it. So we did that. But if we do some global bonds, I think using some of the equity to fund that could make sense. We can have that discussion if you guys want to do that. But the last 3 fiscal years have been really good. What do we have? We were 10.3 for 2023, 22.5 for 2024, and then 12% for this year. After that tough one in 2022, which was maybe 13. Yeah.
23 was the recovery.
All right. So let's next go, follow up on the real estate. So you had asked me, I have a performance analysis, historical analysis of performance and risk characteristics of the Fidelity and the Vanguard REIT index. So to remind you, right, we had this kind of, we had a very good presentation by the Vice Mayor about REITs versus what we have, which is private real estate funds.
And I do have copies of that presentation if you want to reference it. We'll discuss it.
I'll take those. Thank you.
I know two of the numbers are up here.
Hey, what's that on your
Vanguard fixed income.
trade? Look at it.
We're
Do you have a copy of this?
Yeah, yes, I got one from this morning.
So kind of, I'd be happy to have, I would love for your comments, but the highlights, just to remind everyone, REITs benefits are lower fees, more liquidity versus locking up money. And we talked about it, right? 2.5 years ago, we asked for $150,000 from each of those managers. It took us forever to get that money out in a bad market, right? We asked for it right at the height of the market when it was the only thing positive in the pension, and we got over allocated, and then the market turned, and they have the ability to basically limit redemptions in those funds to protect current investors, right? But it certainly limits the liquidity that you have. The positives, and we'll get into this in the performance report, is the volatility of private funds are much less than publicly traded REITs. And I think I mentioned last quarter to the board, from my perspective, I think private real estate for an institutional investor that has access to these funds, ultimately the long-term results are going to be similar to a REIT fund, but you're going to get a benefit from diversification relative to stocks and bonds, as well as limited volatility. So from a risk-adjusted perspective, your returns are much more attractive than REITs. Although in short periods of time, REITs, because they're tied to equity markets, can do much better or much worse, right? So that's why they're a lot more volatile. So I kind of view REITs as a sector fund, an equity sector fund, because you're getting the equity risk of equities, but you're kind of beholden to the fundamentals of real estate. So from my perspective, what my recommendation would be, either we continue with private real estate, or we get out of real estate altogether and put those monies into our equity bucket, because I would rather have a more diversified exposure than just have a REIT sector fund, when I'm getting the risk of equities but not necessarily the long-term returns. So that would be my perspective on how I would view this. So you all asked me to compare what the returns and the risk of REIT index funds to our two managers. So that's what's in this this handout that you see here. It says U.S. REIT manager analysis on the front.
I think you're hitting on it. The question that I would raise, just derivative of what you're saying, is that should we? I mean, if you look at the just take VNQ, the Vanguard Real Estate Fund, over the last 5 years, as of October, is about a 7.5% annualized yield, annualized return, total return. The S&P was 15 to 16%. So the question really is, or the question, one of the questions that I think is not so much do you want to go to the REIT fund, but do you want to just forget about it and go to some other equity-oriented piece, and just sort of go. We don't really have real estate exposure because it's very, it's very, all these big funds, which, and I have no problem with them at all. They basically take the biggest capitalized, the Prologics and all these guys, and that's where they pile into. And so you're just amplifying sort of this sector bet, just like you might make with technology or healthcare or financials. That's kind of what you're doing. So you might just think, well, maybe I want a more diversified look of something. Maybe it's, maybe it's global bonds, so.
Right.
I'm just raising the question as to how you might want to think about it.
I mean,
And that, you know.
From my perspective, right, so I think real estate makes sense for a pension. Because let's use 2022 as, it's actually a very good instructive period. So stocks are down 20+%, bonds are down 10%, and real estate was positive, private real estate was positive 20% that year. Although REITs were down significantly because they are correlated with equities, right? So private real estate, and if you looked at the fundamentals of real estate in that year, we didn't see office space was struggling a bit, but it didn't start to really roll over until 2023, 2024, and earlier this year. But industrial real estate was doing fantastic in 2022. So the economic fundamentals of real estate were more captured in private real estate funds than in REITs, which were down because everything was negative in the stock market. Does that make sense?
May I respond to some of Brad's comments, please?
Sure.
Brad says that the volatility of REITs is higher than the volatility of private funds. He's absolutely correct. However, that stability is a false stability. If you go to my page, let's see. Unfortunately, we have 2 people out of the 5 that were not here. Go to page 6. So, stocks, if you look at how you value assets, they come in 3 categories. Level 1 would be a stock that you see quoted, Apple, any second get a quote. Level 2 might be sorry, I thought my mouth was big enough. Understood. Might be a Ford bond that trades all the time, and then it's a 10-year bond, you price a 9-year Ford against it. So that's level 2. Level 3 is where, frankly, you're making a guess using a model. So if you flip to the next page, I point out real estate assets are hard to value. They tend to be unique assets. It's very difficult. You drive down the road down I-95, you had all these storage warehouses put up. They're all kind of different. You got to look at the location relative to one that might be in Okeechobee and things like that. So use 3 methods of valuation. You can use a sales comparison. Well, what happened during the period when the real estate market froze up? There were no sales. So you didn't have a comparison. It's not like a residential property, household down the street from your house. You can probably figure out pretty quick what it is. The second one you can use is income. Okay, so how much income does this thing generate? There's difficult to come up with visibility between different properties there as to what's generating income. The final one is replacement cost. That's sort of a guess. So what happens is they have to use a pricing service that is making guesses. And I think when you saw that when the private funds were really outperforming the REIT fund, these guys weren't marking the things properly. Like the commercial market in New York was going to hell in a handbasket. Nobody was coming in. They weren't knocking the prices down. And the reality is, if you go to page 8, that if the pricing service is too aggressive in lowering valuations, they risk losing the service contracts. The investment manager goes out and gets the pricing service. It's the same way it works in bonds and equities. You have quoted markets. If you keep beating the price down on it, the asset manager is going to lose fees because lower asset prices equal lower assets under management, lower management fees. So you have a combination of different things going on. The REIT prices, which I point out on the next page, when the market is transitioning from an overbought to oversold situation or vice versa, Brad is absolutely correct. They get very volatile. The issue is more that your private fund is not being priced properly. If you look all the recent discussions about private equity funds, because the Trump administration is going to allow individual investors to get involved in through their retirement plans. What's being pointed out left and right is the same problems there on private equity. You can't figure out what the value of those small companies are until you finally bring them to the market and so forth. So you run into that same thing. So what I did on page 11 was, because you do have all this volatility go on, it's really difficult to look at these private funds versus a REIT equity in a 6-month period or a 1-year period. So I went back over time, and from 2019 to 2025, which should be a long enough period for this volatility to settle out between the way the pricing services prices the assets in the real estate funds, or the volatility in the REIT funds, because they're very diversified. That should kind of balance out over time. And the reality is the cumulative compounded difference between these two, or 1, 2, 3, 4, 5, 6, 6.5 years, the private funds got their butts kicked versus the REIT fund. So you own the private funds. What do you get for them? Well, flip to page 12. Rate of returns over the 6.5-year period were much inferior to the Vanguard REIT fund. Fidelity REIT fund had very good return. Liquidity is abysmal in these things. It's like the Roach Motel. You can come in, you can never get out. It is 253 right now. Say you guys, this meeting went a long time, you were discussing your real estate exposure. You got down to 355 and you said, you know what? We want to get out of every dollar worth of real estate. We think it's peaked. You get on the internet, you go to Vanguard, Fidelity, or anybody else's website, you type in an order, you get a 4 o'clock price. You can't do it with these. They won't let you go. But for the inferior returns, poor liquidity, for that, you get to pay 110 basis points versus the REIT fund at 13 basis points. And you don't even know where the thing is priced. It's only available quarterly. I mean, if these funds were so great where you're giving up this liquidity and you're paying high management fees, it should be the other way around. The private funds, over a long period of time, by using their management skills versus all these REITs, should be having better performance, not less. In my mind, it doesn't make, keeping real estate exposure or not, that's a decision I'm going to opine upon. But, my recommendations were at the last meeting for the 2 gentlemen that were here on page 13 is, if you're going to put real estate exposure in the future, keep it in a REIT fund. And, in terms of the volatility and so forth, you're in for a long haul anyway. So you're really looking at a return. So, unless you decide because of that volatility you want to get out. But if you want to get out, you want to be in the REIT fund because of what I just told you. You could sit there at the computer and bang, you're gone. So, and my second point was, if liquidity opens up and you want to keep have real estate exposure, put it in the REIT funds. Thank you.
Thank you, sir.
I'll just,
So just to let you know, I think there's a bit of a sample bias, right? So the 6 years that are presented, so we do a little bit longer here. So we went back 10 years, so you can see what the numbers look over a longer period. Because I agree, you should look at this over a longer period. With
so I'm looking at page 15 of your presentation, and I think this is an important page to your point about long term. And I think 6 years is an appropriate time, but that's marked by the world really changed in 2020, and with COVID and work from home trends, and also the technology enablement and corporations allowing employees to work from home for 5 days a week, et cetera. So we've had a lot of changes in the real estate market, particularly in the commercial office building and metropolitan markets. This page, just for the board's purposes, if we look at the bottom section of that, the 15 or 10-year time period, you're going to see a bunch of mumbly peg statistics, but these are statistics that I think it's a little confusing because we tend to think in terms of absolute returns. Like what did that investment return? Brad tends to think in terms of this concept called risk-adjusted rates of return, which basically basically takes the excess return, the concept of the excess return over a benchmark, and then it adjusts it for the volatility of that return over, you know, quarters or months or whatever. And that's this concept called the standard deviation, or the variability of the return around the average. And it's kind of gobbledygook, right? I think the trade-off for this plan is, you know, very importantly, you know, and I don't think I was here yet when you guys did the first real estate investments, but you know, the idea there was we were in a very low interest rate environment at that time. It had persisted, you know, since about, what, 2013 or something.
Right, yeah.
And
So our first investment was 2017 in these private.
Yeah, so we couldn't get any yield for like a 10-year treasury in late 21, I think, or mid 21 was like 50 basis points. So before the Fed started to tighten. So I think the board was trying to get some current return, and at that time, you know, the history of these private funds was decent and generated some yield. Okay, then you got caught in this trap. So I look at the real estate not as an equity. First of all, that's why it's in the plan. It was an alternative to fixed income investments, which were not generating any return. There was no yield, and rates weren't going down. If anything, rates were going to go up, so you were actually going to lose money in terms of your total return, market return. What these statistics show me here is if I just look at the return, the absolute return over that 10-year annualized period, Brad, is that, you know, it's kind of like, you know, you got apples and oranges, but they're doing the same thing. They're generating the same rate, kind of absolute
I agree,
return.
yeah.
Okay. And excess returns were kind of unremarkable as well, and I think to, you know, our prior presenters point there that, you know, in the far right, the 0, 0 probably means it was unavailable for some reason over that 10-year time period, that return.
No, so the index that we're using here is the private real estate. It's the NYCRE is the benchmark here. So that's why it's
so
0 there for excess return, but you know.
So when Brad's talking about volatility, he's looking at the next line, which is called the standard deviation. And that is that basically, you know, 2/3 of the time, that means that around that average, one way I think about this is if I look at that return in that first column, the 4.75%, 2/3 of the time, the return is either plus, you know, 4.75% plus 18% or minus 18. So it's bouncing around a lot. But then when you measure, there are these other measures that we use in the business, like Sharpe ratios and information ratios, and what they basically measure is, did you get rewarded, okay, for the risk that you took, okay, in your investment. And this is all about the variability in the mark-to-market. You know, every time we come and look at the numbers, you know, you feel bad if it's down for 3 years, but, you know, 3 years down the road, you could have positive volatility. So the point being that I don't think, in looking at these numbers, which is a long period of time, I don't think that the excess returns or the risk-adjusted returns in terms of the Sharpe ratios and the information ratios relative to the REIT funds is that remarkable. You know, so even though the risk-adjusted returns, you know, might look better for the private equity than, you know, what you give up in terms of tactical ability, in terms of liquidity, is, I think you're giving up a lot. I think, you know, we had to endorse.
Well, I mean, it kind of depends on like when it's it is wonky, right? But you have double the risk-adjusted returns, right? You go
well, yeah, but we're talking about
0.2 to 0.5.
But we're talking about marginal.
Yeah, but that's the nature of the calculation. But yeah, at the end of the day.
So if we look at, I mean, we can see that, you know, the image of that on page
3.
No, it's actually on page 12. Is it page 12? Yeah, page 12. Yeah, and you can see in these bar charts here. You can see so I circled. You can see that the information ratios are higher. Okay, so this is 10 years, and these are these same statistics. And you can see over here on the far left, like, this page 12, you can see that the standard deviation, or the actual, like, this is probably quarterly volatilities or something, or monthlies.
Quarterly,
Okay.
yeah.
So you can see, like, it's very high for the REITs, right? And it's much lower for private equity, and to the point, like, that's because you don't really ever get a mark to market, because you don't get appraisal prices. And it's kind of, well, you know.
I do want to make a caveat, so we can argue whether or not there's like, I agree with some of what you said, but the mechanism, unless we're in a period where nothing is going on, which happened during COVID, and then probably at periods of 2023 when they are marking to model a bit because the transactions aren't there. When transactions are there, the pricing service is going out and looking at the prices of similar buildings in that market, whatever, whether it's Boston, whether it's Miami, whatever it is, and using that along with other methodologies to come up. So I don't think the very pessimistic view is that they're just kind of making this up. I think that might have been some verbiage. I think there's a big methodology that at certain times you got to do what you can to come up with a value. If there's no sales in a market, well then they have to have the other three or the other two areas. But number one would be comparable sales of buildings to come up with the value, like price per square feet, whatever they come up with. The managers would be better versed to tell you exactly how that comes to our
I kind of
research.
feel like at the end of the day, if I'm looking at a 10-year time period, and these aren't rolling time periods, because we know
Right, this is just at this
we know
stage.
we've had a lot of bias in the last 5 years. But I think it's hard to justify the lack of liquidity and tactical ability and getting the door shut in your face. And say,
Yeah, I
say,
mean,
can
certainly
we at least not reinvest the dividends?
From my perspective, right, it's like, okay, if you want to have this, if I'm going to get the same return, well, I want half the risk. So why would I go into we don't need that 7, 8, 10% liquidity. We have 90% of our fund that we can get tomorrow. So we have some ability to take liquidity risk.
So that requires a very long-term commitment to real estate.
Yeah.
And that means basically we close our eyes for 5 to 10 years, and I think that's hard for a public board of trustees.
Well,
No, I get that. It is hard. It is hard.
Yeah.
Without
I
question.
mean, you had that situation where the private funds had this crazy return. I remember discussing this in the town council meeting. They were up 40 percentage points. Everybody tried to get it out, and they couldn't get out. Did that tell somebody at the pricing service that maybe you have these marks way the hell off? Experts have slammed the gate.
Just for the
Just
record,
not realizing.
I think the year you're talking about is 2021, where the private funds were up 20% those years.
Well, I looked
The
at.
REIT index were up 40% that year. And then the next year, 2022, the REITs were down 26, and the private funds were up about high single digits.
So I also think you got to bring this back to real estate versus investing bonds.
Right.
Yeah.
Because definitely if we buy, I don't know what the REITs real estate is, and the REITs used to be kind of an independent sector. Now they are part in the S&P and the benchmark classifications. They are now a sector inside the market. So when we own the S&P 500 benchmark here in our index, and 2.5% of that, I think it's that the sector weight today.
Yeah, it's something.
Probably 2.5% to 3% of that of our S&P 500, index fund is actually REITs. So that is definitely a differentiating factor that's brought to bear. So we would, in effect, be adding to our equity exposure because all those REITs are in the S&P general, the broad market benchmark. So it's complicated.
Yeah, and we get a little bit of exposure through the Russell 1000 value ETF. It's actually going to be a little bit larger percent there too, but yeah. Your point is, yes. I guess from my perspective, right, it comes down to what I said earlier, right? We're going into a refund gives you the risk that we already have, that's our major risk in the pension. You get a different risk here with the private fund. So if we're going to, I don't think making a sector bet on real estate equities adds anything other than risk where I'm not getting compensated for it with total equity returns. So that's the math that goes on in my head, right? It's like, okay, I get all of the issues that you have with private real estate are there. And while I think a pension has the appetite and the capacity, particularly for when we're talking about less than 10% of the pension, for those liquidity kind of issues, if the board has a position that it does hamper us that much, I would not recommend that we go into REITs. I would recommend that we either go into more equities or more fixed income, because you get the benefits of the liquidity and you're not handcuffing yourself with the sector.
Where are you getting compensated for the 110 basis point fee?
Yeah.
That's the question
And
that I would.
And that's another very good
All of
point.
the returns are net of fees here.
I mean, between liquidity and the fees, those are two big, anchors that prevent your,
And Brad, is there a kicker on the fee on these funds that if they exceed a certain return based off of the benchmark,
Yes.
that we have to pay more
For Intercontinental, not for principal.
for Intercontinental?
Yeah, so,
Okay.
and we round up the fee, their fee is,
Okay.
management fee is lower, so if you see, but then they get 10% above 8% preferred. It's kind of convoluted. If you remember, we actually got our net fee was higher than our gross fee because we got a rebate because they didn't hit their mark after they got the incentive fee. But anyway, that is correct, Vice Mayor. For Intercontinental, they get an incentive fee for that fund.
but if we're just interested, let's just say, forget about risk-adjusted return. If we're looking at absolute return, it looks like over the last 10 years, there's virtually no.
Yeah, you got a little bit of a
Significant
premium for the
difference.
Vanguard one, but otherwise, I mean, you're within a
On
point
this
of.
last page in terms of the absolute return.
Right, if you looked at the 10-year for the S&P 500 during that time period, right, you would have gotten double-digit, 12% annualized over that time.
Right, but we're looking at this as a diversifying, absolute
We're
return.
looking at uncorrelated, something uncorrelated perhaps to.
Right, and that's my point, of going into a refund, you're not getting the diversification benefits, you're getting the risks of equities. So.
It's hard
Well,
to-
even with
I have
that
a
being
hard
said,
time getting my head around
why
because-
would we be in a REIT fund that's 110 basis points versus 13 then?
Because you get less volatility and you get more diversification benefits for the funds that we're in, right? 2022, stocks and bonds are both negative double digits, and it was a positive return real estate market, which we experienced and helped lessen the impact of our pension.
I mean, in one way, the underlying assets are the same assets, right? One is just securitized or equitized, let's say. It has liquidity. But.
And it's more diversified.
Right, and more diversified, but I mean, you can take, a strip mall, the strip mall, you can own it in a private equity vehicle, okay, a medical offices or something like that, or it could be in an ETF, it could be securitized, right, it could be like equity. Now, the equity the underlying asset value may not be changing. I mean, these things could be like, a duplex, right, half public and half private. But the investors can vote with their feet, every hour, every minute on the liquid one, the REIT part of that. So, so the price gets adjusted, is varying based, on the daily movements of the market, interest rates and everything else. But the private one is just not changing. So that's kind of the way I think about it. So I think, again, it comes back to, if you're willing to hold for a long period of time, you're probably going to get more volatility definitely with the REIT, with the public REITs, but you're going to have liquidity and lower fees. But you're going to basically end up in the same place, over rolling 10-year time periods or something like that. But that requires you to be, so,
So why, and I think I asked this question a couple meetings ago, why did we get into the real estate to begin with? Was because we want to have a diverse portfolio, right? Wasn't,
Yeah, so he
Yeah, that's
he
right.
explained it, right? At the
And it's
time of
not
2017,
uncorrelated,
interest
probably.
rates were very,
Uncorrelated
very
asset.
low. This was a yield, this is an asset that has a current income component, right? If you think about your expected returns for private real estate, you're thinking over long periods of time, you should get 6 to 7%, and 4 to 5% of that should come from income. So it's similar to, actually, you have more of a capital appreciation component than bonds, but much different than equities, where if you think you're getting 10, you might get 2 from income and 8 from capital appreciation. So that was the thought, is that you get an income generating asset that's an alternative fixed income that's not making any money for you. It also provides inflation protection like we saw in 2022. 2022, if you remember, inflation was 9% of the economy, which is why stocks and bonds were both negative that year as interest rates went up significantly and real estate was positive. And then you also get a diversification benefit in that historically over the last 50 years, real estate does not act like stocks and it does not act like bonds. So from a total portfolio perspective, it helps smooth out your ride and your volatility because it kind of zigs when the other things zag. Does that make sense?
yeah, but why do we need to keep it in real estate then? Why can't we move it to something else? Dare I say,
absolutely
like,
can.
why don't we put,
Can you?
Do you guys do any triple net lease deals? I mean, I'm personally invested in one. And I mean,
I
they're
think-
very attractive because they're basically just, you just get an income stream.
I think there might
8
be.
to 9%. And I think that's kind of almost more the vehicle that would be more palatable for this.
Well, so the only fund that I know of that we have available would be a private equity real estate fund, which is even more restrictive than what we have. Right here, we, at least in a normal environment, you get quarterly liquidity. So this is a true private equity structure where you would invest in them. And I don't know if it still opens for they might have raised the capital, but the one that I'm thinking of, it's one where, it's a 12-year life fund, you put money in, they go out and do deals, and then you get the money out. You're locked up for over a decade.
how much of the portfolio does this represent? Real estate, 8%, 9%?
Yeah, we
was
have
it?
about 7%.
7%.
Yeah.
Why don't we just do something different with it if that's what we're looking to play with? I mean, what about cryptocurrency?
Yeah, no, I wouldn't recommend cryptocurrency. I don't think it's very, very volatile.
Why?
Yeah, so you're
Well,
talking.
this is volatile tool, isn't it?
No, not like.
Not like crypto?
Crypto has 50% drawdowns in 3 months, and it's happened multiple times.
I'm just throwing it out there. I mean, there's a lot of government bodies and people that are going to it. The president seems to be pro that, but
It's not a decision we can make now anyway, because there's no liquidity in the real estate, right?
Yeah, I think.
So, I mean, this is all.
You absolutely can make a decision. You can say, hey, we want to redeem all of our money, and we're getting more money than we did 2 years ago.
Okay.
So Intercontinental, they were giving us 2% per quarter for a while, then it bumped up to 5. Last quarter, they gave us 10% of what we had outstanding. So things are, but it's.
the point is that we could park it again, or we could do something different
Yeah,
with it, rather than leave it in a REIT fund if that's what we wanted to do.
To the vice mayor's point, right? You put the redemption in, and then it takes a while to get, we're still waiting to get, we only asked for 20% of, I don't even know if it was that much, so we asked for 150,000 from each of them. We had over $1 million invested at the time in each of those funds.
And we're still waiting.
And one of them, we got all of our money, so principal paid us out all of that, but we're still, we've only gotten maybe about half to 60% of what we asked for 2.5 years ago from Intercontinental. So if we,
Well, is this a normal real estate market? Because if it is, why don't we have our money?
no, no, it's not.
It's not. I mean, it changes every day. I mean,
We've had 3 bad real estate markets, right? In the early 90s, when the savings and loan crisis happened, you had the financial crisis, 2008 to 2010-ish, and then you have this time period.
Well, we're
so
5 years
It's not a
past.
normal environment. Yeah, it's not.
I mean, I would kind of lean in here to, we haven't been happy with these for a long time, which is always a dangerous sign, right? Because you're getting out right before the turn, but I don't really think there is a turn. I think that the question was asked, like, why do we ever do these things? And I think part of that decision was probably looking back in retrospect at the historical returns of real estate, which have been good, to long-term investors, I don't think anybody anticipated, COVID, and nobody anticipated
Sure.
the way that people would work, in the gig economy or whatever we want to call it, in modern times. I mean, my kids work from home 3 days a week, and out in Denver. I mean, and they're literally like a mile away from their offices. I mean, that's the way people work these days in tech industries and whatever. So, and that's a big headwind, I think, ongoing to anything other than Class A real estate, which is new stuff. I guess my suggestion would be that because this has been going on for this is the third meeting, I think, that we kind of come up with a compromise and we ask for more money back. And, even if we bought, if we put the money in T-bills for a period of time until we decide what to do, we could put some into REITs, and continue to look and consider, alternative, again, this kind of, to me, comes back to, this was an alternative to fixed income. Now, large institutional plans have large commitments to illiquid assets, like real estate, venture capital, private equity, but I don't consider, $21 million.
It's $21 million. It's
It's
not
a lot
large
of money,
pension.
but it's not,
a large pension.
It's not the Florida pension plan.
$500 million is a large pension, right?
Right, yeah,
Well,
so,
if I can just make a point to that, they have a lot of these restricted funds. Look what's happening now with the Ivy League schools, where they needed the
Yeah, they
money.
secure it.
They suddenly find out that those returns that they've been telling every other investment manager have been, that they're so superior to everybody else, they're not anymore. They can't get out of stuff without taking 30% discounts and things like that. So what has Harvard done? What has Princeton done? They went out and they issued bonds in the market, get liquidity, because they can't get out of this private equity and all these other things. So, I mean, it just backs up my point. The marks look great until you need the money. The only price that counts is the price you sell it at.
that's right.
Well, there's liquidity until there's not liquidity. And that happens.
Liquidity is always there until you need it. That's what we
You
used to
can
say
sell anything.
on the trading
You
desk.
You can sell something, but price is the key thing.
Yeah.
And that's where liquidity, so.
I mean, we're already kind of running into that because we put a request in and you're saying that we got part of it, but not all of it.
Yeah.
And that was what, 4 months ago, 3 months ago?
Couple years. That was in 2022.
Oh, 20 years.
Yeah.
Scratch that,
Yeah,
2 years
inception
ago?
dates.
3 years ago?
September.
So I make
2022, so, yeah, which is why we
Try to
don't,
get as much money out as
unlike
possible.
an Ivy League endowment, which has 75+% in private investments, that's why we had a 10% target, so I do want to address that, right? Again,
No, I would suggest.
yeah, we have 93% of our fund today, we can access tomorrow, so we're good on liquidity, we're not going to miss a benefit payment because we're tied up into the real estate fund, but I think that's a perfectly fine compromise that I would support. Part of my thought of where we decide to go in global bonds would be to reduce our real estate target, right? Right now, we have a 10%, we're at 7. If we have room to just make that change now, and we don't have to ask for any more, but if we're asking for more money, we can even take it down further, and I think that makes sense to me.
So the global bonds, that's your next presentation for an alternative?
Yeah, I think,
Can I say just, Mr. Chair, for meeting, if you're changing how much money you're taking out of the refund, somebody should make a motion in a second.
Well, I think we're going to go on to the next presentation to hear what the alternative,
no,
before we start.
that decision is independent of what you
Right.
guys decide on the real estate. So I agree, we shouldn't move on to the global
So you
bond.
need a motion on what we're going to do.
Can I just interject? So we don't just kick this, down the road again. I think we should put in how much liquidity is in our, private real estate at this point, and how much can we request to
So
it?
you could request every single penny that you have. What will you get? So I can tell you last quarter, you would for Intercontinental, you would have gotten 10% of what you had asked for.
Mhm.
Principal has been more liquid, so they've already paid us everything that we've asked for.
And the current allocation.
So now I don't know what they paid out last quarter, so I don't know what percent of their the redemption queue. This is for principal, but I do know Intercontinental paid. So if they had $1 billion of capital that people have asked for, they paid out $100 million, 10% of what they asked for.
I think there's a strong case for, you know, moving to a more liquid, lower fee structure.
I agree.
Position. And so I mean, I would support, you know, taking at least half of our real estate, you know, commitment, current real estate commitment out and converting it to liquidity. Now, if we wanted to go into, you know, short-term treasuries or intermediates or something like that for the time being, or to even go into, you know, REITs, I would support that. Just as a I mean, I think that's a diversifier within that asset class. It's a lower fee structure, it's you know, much higher liquidity, and if, you know, we're committed, I mean, we're gonna generate the same, higher volatility, but we're gonna probably generate, you know, positive information, positive sharp returns, we can, sharp ratios, and we'll add value to the plan. Maybe with a little bit more volatility, but you know, it's, you're not going to see it.
If we request,
it's such a small part.
if we request a liquidation of some or all of Intercontinental or principal, when would we see those dollars?
I have no idea. That's the thing, right?
No, but I mean, we're not going to see it tomorrow.
Yeah, so every quarter.
Are we gonna see it this calendar year?
Every quarter they evaluate liquidity, do they have someone that can buy some buildings to generate liquidity? And I agree that they're not incented to really, like, search out, right? They don't wanna lose them.
Right.
What I'm really asking is if we made the request
Yeah.
today in October, have we, you know, do we have any opportunity to see any money before the end of this calendar year?
So yeah, so we'll get, if we did it today, we would get, well, I have to go back and look, because sometimes it's.
I mean, if it's quarterly,
Depends
there's
on
a
the
cutoff,
timing.
and it could be
It-
3 or
it
4
is-
months
yes,
later.
Every quarter, they evaluate and they pay out their Q. So last quarter, Intercontinental paid out 10% of what they had in the Q. So we'll get whatever incremental dollars we had, that we get added to that Q.
Right.
And then they make a determination of what they're gonna pay out, given the liquidity that they have.
Right, so
just move it on.
with that illiquidity, what I was just responding to was, do we make the investment decision today when we don't know how much we're getting or when we're getting
That would not be my
it?
recommendation. I would
Yeah.
recommend that we just put that like we do now into our R&D account, which goes into a money market mutual fund.
Right.
And then at a certain point, if we accumulate enough and we get it, hey, we got 50% of what we asked for this quarter.
When we
okay,
relook at
then
it,
we
then
can-
we should just-
The next meeting, we can make a decision on that. But yeah, I don't think it makes sense right now to say we're gonna put it in X when we don't even know what the amounts are. But yeah, I think what I would recommend is that we just submit the redemption, and then, you know, I'll report on that every quarter, what we've gotten from those funds, and we can make a determination on what to do with it, other than the money market fund, if we get to kind of a scale where it makes sense. Does that make sense?
Just one point of clarification, VNQ that you're referring to, that's an ETF, correct? As opposed to, or do you?
I think you can buy it either way.
There's a-
I'm agnostic as to ETF to mutual fund.
Because you were talking about.
I did all my returns using the mutual fund numbers I went back as far on my returns as what was in our book for the pension fund. That's why you go back 10 years, because I didn't have those numbers, so.
Yeah, I just clarify.
Yeah, it's 618.
Like, try to withdraw 50% of each, you know.
Because you don't need to wait till 4 o'clock to sell BNQ. You can sell it.
What are the current yields on,
That's true.
what are the current yields on these REITs?
So I just put up BNQ because I just wanted, the expense ratio is the same as the institutional mutual fund. Let's see
It's probably
what
about
the yield is.
5.5%.
7 basis points, I think.
So yeah, it's 0.13 for that fund. Let's see if I can find the yield.
I think it's about.
I mean, you get paid while you wait. What income,
It's 5.5.
what has been the yields on our private real estate?
Right around 4%.
Yeah, I think it's around.
So comparable.
Yeah.
it's like 3.5 on the principal at September of 2025, and Intercontinental was 3.86. We have 800,000 in Intercontinental and about 740 in the principal.
I'm sorry, I can't find the yield here on the Vanguard website.
So Mike formally requested
I think it's
recess
around
if I can
five.
run the bathroom
No, go ahead,
real quick.
go ahead.
5.25, something like that.
Yeah, I think I just have it.
I think it's something like that.
VNQ.
V and Q. It's around 5.5 -ish.
Okay. The current unadjusted effective yield is 3.5% as 3.56%.
On which?
V and Q.
As this is for the VNQ
I
ETF.
think it's,
Right.
Okay.
I think so.
Guess we have to wait for the member who left.
So just to give you, should I wait?
I think we have to now, I mean,
Okay.
yeah. I mean, conceptually, I would recommend here, propose that we take, put in to sell 50%, redeem 50% of our private real estate.
Yeah, it's just I think it's
You
just
know,
a
And to the extent that we get funds,
Yeah.
we'll
yeah,
redeploy them to the extent we get any redemptions.
So as of 9/30, we had $1.556 million between the two funds. So that's 817 in Intercontinental.
About 7.5%.
1.56.
In Intercontinental, or in
Yep.
principal. So it's rounding up about 750,000.
I
Would be
just
half of
suggested
that,
that we
and
sell half.
half of that.
Okay.
And then we
Would be- so-
redeploy as funds become
So
available.
so half of that would be 750, half of that, so 375,000 from each of the managers would get us down to about half of where we're at right now.
Are you making a motion?
Who is slower to liquidate?
Over the last few years, and it's hard to, because it could change, so I just want to make that caveat, but Intercontinental was much slower than.
Do we have a current request for liquidation at all, or?
Yeah, so yeah, we've gotten a decent amount back, but we still have a little bit outstanding with
Intercontinental?
Intercontinental. I'd have to go and pull up my laptop and figure out exactly what that dollar amount is.
So if we got half out, that would take us to like 3.5% of the total fund.
That's right.
Okay.
That doesn't, you have to do half of
yeah, it's
principal,
about
but
4%.
we already have some requests for intercontinental money, so we have to figure what's left, right?
Yeah.
I mean, it's more math.
Yeah.
We have a standing
Let me
request.
see if I can
You
find.
have a standing request.
And there's a shot that principal will have, if we liquidate half of principal, we'll probably see that much sooner than Intercontinental.
Yeah. Fine. I mean,
Yeah. It's not,
neither's really not,
it's not,
we're off the
it's not
ball.
gonna, yeah, it's not moving the needle
No.
about that amount of money.
Yes. Yes, that's also a complicating factor, right? So Intercontinental we have slightly more with Intercontinental.
The only thing worse than being illiquid is being illiquid with bad returns. Right?
Yeah, I'm not, to get the.
Subpar returns, we'll call them. Right.
To get the exact amount that we have outstanding, I'd have to fire up my laptop and do a little bit of work. I think, I mean,
Just do a flat dollar amount, would be reimbursed.
yeah, I mean, if you want to do
Two funds.
400 out of principal, and this is all rounded. I mean, if you guys want, I could do the exact math and get back to you, but I think in order, the spirit of what we're trying to do, if you did 400 for principal and 350 for Intercontinental, when you add, we probably have about, let's say, if we got 2/3 of our money to 150, we have $50,000 left. That makes sense to me. I think that's roughly around right. Then the net result will be even for each of them, and get to our kind of target of reducing the exposure. So
That's good.
So you're suggesting 350 in addition to what we already have in there
yes,
in terms of request?
So I'll make a motion that we remove 400,000 out of the principal real estate and another 350,000 out of the Intercontinental real estate.
I'll second that motion.
Okay. All in favor?
Aye.
Just going into.
Progress.
Okay, thank you, good discussion.
Sorry, who's the second?
I second it.
All right, we'll get that over and get this submitted. All right. So the next presentation, so it's been a long discussion. Are we prepared to go through the options for global bond managers today? I just want to take the temperature, I don't know.
What's the impetus for that? Just because
Yeah.
I missed,
Yeah, it's
two
good.
of us weren't at the last meeting.
Yeah, so I thought, we don't have any non-dollar assets in the pension right now. All of our domestic equities or our equities are domestic equities. We were having a discussion about, tariff impacts on potential, we were up until 6 months ago, we were at all-time highs in the dollar. You look at a long-term chart of the US dollar, it kind of tends to go over time. We were at the top, I don't know what the standard deviation is, but one, diversify the pension might be an opportunity to get invested in something that we don't have. Rates are attractive generally relative to the last 15 years. So that was all kind of the discussion that I brought up last quarter, of potentially putting a little bit of money into global bonds.
And how would you fund it coming out of?
From the strategic asset allocation perspective, I would add it as a new asset class, and the source would be real estate, because we have a 10% target in real estate. We're at 7. We just reduced it to lower than 5, so I would just take it from that. And again, it kind of gets to, if you think about back in 2017, I'd have to look to see what the IPS was before it, but our recommendation would have been to put 10% in real estate and take it from fixed income at that time. It wouldn't have came from equity, more than likely. It would have came from the fixed income. So this helps us kind of get back to, again, an income generating asset that provides some diversification, the spirit of what we were trying to do with real estate. So that's how I would think about it.
What are the characteristics relative to, let's say, U.S. Ag or something like that? I mean, you don't have those in here, or do you?
No, I just have the global ag. But you can kind of cross-reference if you look at so global bonds up until the last 6 months for the last decade have not done as well because the dollar has been strong, right? So there's been kind of for a true non-dollar hedged global bond fund, which we have one of those in here, the returns don't look that good relative to U.S. bonds historically. So this is kind of like, an idea to, being proactive to add something with you. Might have a little bit of a tailwind from, any dollar weakness that might be sustained. Now, you might disagree with that, and then we can not go down that route. But you can see we have some good funds that compare favorably to, even historically, to a normal kind of U.S. aggregate bond fund. But there's some caveats there. They're more credit focused, so not as much government exposure. And then the PIMCO Global Bond Fund, we can get into this that we have here. PIMCO loves derivatives, and they might state they have exposure to sovereign debt, et cetera, but it's all kind of done in a kind of very less than transparent way because of the way PIMCO runs their money, and just they have so much money they can't get cash bonds, so they can't go out and buy whatever Argentinian debt or Brazil debt. They have to do it through replication. And the vice mayor might know this better as his background about PIMCO's trading desk, but yeah, they use a lot of derivatives for exposures.
Definitely. PIMCO has a very heavy derivative they'll have leverage like 33%. Now, it's not leverage like you would think in the equity market. It's sort of balanced off. But I could just make one comment, and I'll shut up on this discussion. One thing the board has to think about, and I'm not against global bonds, is whether you want to do them foreign currency hedged, where you're basically not taking risk against the US dollar, or where you want to do them unhedged, where you are taking risk against the dollar, but you can also have potential performance returns against that. If it's currency hedged, the hedges cost you return, because it's like buying a form of insurance. So, but you know, if you're unhedged, you're going to have versus when you take returns and put them back relative to a dollar return, because that's how you're paying out your employees or dollars. The returns are going to be more volatile versus the U.S. domestic bond, which, you know, may not necessarily be a bad thing, but that's something that you have to think about if you go in that.
Right, yeah, I agree. And that's why I said, you know, a non-hedged fund, and you'll see it here, we have the Loomis Fund, great team, great team over at Loomis, been this a long time. Their returns just don't look competitive relative to the other three funds that are all hedged over the last decade. So if you look at the 10-year number, you're gonna be like, why would I consider this? Well, it kind of depends on how you view that. Do you want to eliminate currency risk, or do you want to accept some non-dollar currency exposure, thinking that it might actually be beneficial in the future? So that I completely
We
agree
want
with that.
to have a manager that has a discretion. That's why you pick a manager who has a discretion.
Yeah, exactly. So what do you guys think? Do you want to go through this? Do you want to, you have it now, do you want to table it and review them and come back next quarter? What do you think?
Send it.
All
I
right.
mean, I've always had a personal bias, you know, and just, you know, our liabilities are, you know, functionally U.S. dollar liabilities, right? I mean, our beneficiaries, participants are dollar-based, they're U.S.-based. So sometimes I say, is it really worth it, you know? It's kind of like adding an ingredient to a cake or something, and like, what does it do? Well, maybe you don't taste it, but maybe it's like the wrong ingredient and you really taste it. And it's kind of like it overpowers the cake. So, I mean, I've always felt like that about U.S. equities also. And I kind of wonder if there's not another way to skin this cat by, you know, maybe moving out on a, you know, credit spectrum or something like that, you know, with U.S., you know, with U.S. based investments, or you know, I don't know. I mean, what are, you already said that a lot of these benchmarks are credit, you know, they're not government debt.
You have four funds here. Two of them are global credit. So there's a PIMCO Diversified Income Fund that I use a lot. So that has 60% U.S. exposure, 40% non-U.S., but it's all credit. So it's securitized, it's, you know, EM, it's, you know, they have exposure to non-investment grade. So it's just, you know, they're using their global platform. And then we have this Hartford fund that's sub-advised by Wellington, that again is a multi-sector credit fund that they're going into those same sectors. So that they're like kind of the two that, you know, if you're not, you know, if you want something that is taking on a little bit more credit risk and you know, you'll get a yield advantage over the long term, they would be the two funds that I would think about here. And you'll see that the historical results are pretty strong there. And then you have this PIMCO Global Bond Fund, which is more of a, you know, it's a, you know, basically it's they have sovereign debt, a lot of things, but you'll see it's hard to tell because the numbers are so wonky because of the derivative exposure, but historically they're significantly underweight, you know, government bonds, and both, you know, domestic and internationally, and they're taking a lot of credit risk. And then you have this Loomis Sales Fund, which is, you know, again, a true global bond, unhedged product that is a little bit more traditional than the PIMCO Global Bond Opportunities Fund. So I wanted to kind of give a couple different perspectives for you guys to consider here.
So where this is being consider it in lieu of, okay, real estate on the one hand, and then, but also I think it would be.
Domestic fixed income?
It would be, yeah, relative to our domestic fixed income. So I think to do this, we probably have to look at like the return and risk characteristics relative to, you know, maybe our current benchmark, like the ag or something, or.
I mean,
what's the,
Before we start drilling down into managers, just to see if the diversification
I mean,
concept
I'm
makes
not,
sense.
you know, yeah, this is kind of not my domain, so, you know, global fixed income, so you guys are the fixed income guys.
Domestic.
look at, I think, so I get what you're,
But from the-
I can certainly put together something like that.
From the standpoint of the plan, like, what prospectively, what would it be doing?
Yeah, what's it solving for?
Yeah, so it would add another, it's
Just
it's
diversifying.
safer than equity, so it's a different type of exposure. It's different than US bonds too, so it's almost, I get where you're coming from, like, it's
Yeah.
like, okay, let's look at it relative to where the source would be, but it would be its own thing, that would provide a different, you know, you're gonna get some diversification benefits from being in global bonds relative to a US bond. So it's kind of its own category, but generally speaking, it's fixed income, so it falls into that bucket.
But generally, over the long term, I mean, the total returns are higher than US returns?
Well, it kind of depends, again, that.
Like, let's just say of comparable credit quality?
Yeah, so,
I mean, what is
so you're
the,
gonna be a little bit extended, but if you look at, it's a little bit of an apples to see, so yeah. So, I printed these off without page numbers, I'm sorry.
It's really.
yeah, I'm kind of looking at the last
Yeah,
page.
it's global.
But if you look at the let's see,
Last-
5-year number for, in our quarterly report,
Yeah, I was looking at that. The 5-year number for domestic fixed income is
yeah,
terrible.
0.3, and then, you know, most of these, other than the index and the Loomis fund, you're getting a big premium here. And then, I don't have a 10-year number in our quarterly report, but you can see, like, since inception, the domestic fixed income policy index is 2.59 since 2013, so that's 12 years. So if you look, you know, 10 years, you got a premium for, particularly for the credit funds, the diversified income and the strategic income fund. But you are taking more, you know, it's more credit risk with those funds, because there is going to be some below investment grade exposure, which you'll see in the characteristics here for those credit funds. So you say, like, in apples to apples, I would have to come back to you and show you a more, a different analysis than what you have in front of you.
And how correlated are these global returns to, let's say, you know, GovCorp, you know, or a US GovCorp?
I don't know the answer.
I mean, I think that would be like, you know, a correlation of, you know, there's an R-square like 97%, and I say, well, why am I doing that?
Yeah, I get what you're saying, yeah.
Yeah. Because I think that the context of that, otherwise we're kind of shooting in the dark. Do you guys concur with that?
I think I'm in agreement. If we're being asked to consider an additional asset class, before we start drilling into managers, I think we need to understand what does adding this additional asset class do for the returns and the volatility and risk.
Yeah, yeah, no.
First question is, are they all liquid?
That answer is.
Get out if we get it.
I knew that was coming.
Moral of the story.
It's liquid after 10 years, I'm out.
It's not a Roach Motel, we're good.
All right, I think I get the gist of what you guys are asking for. It's very, very, I think, a good question. So let me come back to you next quarter. I'll put together, you know, not just, I'll bring this updated, but I'll bring another analysis to give you a sense for some of the kind of more asset allocation type of decision, and some of those metrics, correlations, and kind of how that all looks. But I will say, right, I think, you know, from a historical perspective, U.S. is going to look better, primarily because, particularly for anything that has not, that's not hedged, because you've had this tailwind for the dollar. And that's part of the story here, is like if you think that the dollar might weaken and it might be structural and you might be in a period, an extended period, then this might be an option to consider, even though historically it's not going to look good, but prospectively there's going to be a tailwind for non-dollar exposure potentially. So that's part of the deal. But I think we can put some numbers together to kind of give you a better picture of what this looks like to make a more informed decision. So I'll go ahead and do that. All right. And then lastly, I have update for the investment policy statement. I did not update anything in the strategic asset allocation. We can hold off to that, but I'm also thinking, well, maybe we should just wait till we get some money to adjust the real estate, because our real estate target is 10 right now. You know, we're at 7 because we're underweight, and we're just got more money. I'm thinking, does it make sense to lower that target now, or should we just wait till we get more money out of it and then kind of take it down to 5% or whatever the remainder is at that time?
Well, I mean, our minimum, we have a target is 10, but we have a minimum of 0.
Yeah, so we're within policy right now.
That kind of gives us the degrees that we can.
Yeah, the only thing that I'll say is that we base our policy index on that 10% target, right? So our fund policy that we compare the total fund to is based on these strategic targets. So if we ever get to a point where we have 0 in real estate, it doesn't make sense just because we can go down to 0, we're still going to have a 10% in our policy index, unless, I don't think we're at a problem now, but down the line, I just want to give you a heads up.
Yeah, I see.
Does that make sense? Kind of, you'll be a little bit apples to oranges when you're comparing that, unless we change that. But I'll keep it that for now, and we can adjust it time. But if you flip to page 6, Bonnie, did you talk last quarter to them about the Israel? So last quarter, in July, there was a new law passed where not only can you not, you can, when you want it,
Sure.
because 2
So,
people.
there was, during the legislative session, there was kind of an expansion of the requirements on entities that boycott Israel. The SBA has long been subject to a requirement that they can invest in entities that boycott Israel. And they have a list of companies. There's 18 companies on it. 12 of them are some form of Unilever around the world. Unilever is the parent company of Ben & Jerry's. And so, you know, they're on the list because they own Ben & Jerry's. My understanding is they're trying to get somebody to buy it so they can get off of these lists. But at any rate, you know, there are a couple of foreign countries that are on the list, but Unilever is probably the most common. The SBA, or the legislature expanded the requirements under there. So first off, any contract that you all enter into from this point forward will need to have a provision in it that indicates that if the entity that you're entering into an agreement with becomes an entity that boycotts Israel, you have the right to get out of the contract. The second thing they did was they expanded the entities that it used to be companies that boycott Israel, and they've now expanded it into entities that boycott Israel. And so local governments, which you are one, can be found to be entities, can be added to that list as a scrutinized entity. School boards, universities, local governments in general can now be found to be entities that scrutinize, entities that boycott Israel, and be added to the scrutinized list. And so your contracts can be voided, right, by the entities, if you have any governmental entities that you enter into a contract. So one that we looked at was, you know, whether investing in entities that boycott Israel, whether, you know, having Unilever as one of your investments in your portfolio could mean that you are boycotting Israel, and therefore be put on that Israel list. So we're recommending that you amend your investment policy guidelines to follow the provisions of the State Board of Administration, that you would not invest, you would ask your managers not to invest in companies that boycott Israel. So what that means is, if you own directly with an investment manager, one of those entities that are on the list, you would divest from those. You would ask that manager to divest from that stock, sell all of the Unilever. If you owned it through a mutual fund, your requirement is that you notify the mutual fund company that there is a list in Florida that boycott of entities that boycott Israel, and you want them to create for you a mutual fund that does not have Unilever in it.
So you said that you notify your manager to request that they abandon, but.
If it's an indirect holding. If it's a direct holding, you would need to divest from it.
Right.
But an
But
indirect.
otherwise, you have to have some proof that some evidence that you notified the entity, or the manager that you had requested, or you would be
So
subject to
you
a
have
violation.
yes. So you have this requirement already with companies that are complicit in things that are going on in Iran and Sudan.
Right.
You already have that requirement, and there is a process that's set up at Mariner where they notify your mutual fund companies on an annual basis, indicating, remember, there's a list, you need to look at this as you buy stocks and not buy anything that's on this particular list. So they would just add the boycotting Israel list, which is basically in the same place. The first button is scrutinize companies in Iran and Sudan. The next line is companies that boycott Israel. So it doesn't add too much to the criteria.
Does this have a name, like is there a nickname for this rule, or?
So the law back in 2010 was called the Protecting Florida's Investment Act.
The original one, but
Yeah.
I don't think there's a name for the boycotting Israel one.
It's under the same statute number, right?
Statute something.
Yes.
What is the penalty for not divesting
Well,
for the entity?
for you all,
Well, not us specifically, but if an entity did not divest from,
if you ask the manager that you owned the stocks and they didn't do what you asked them to do, guess who you fired?
what if the entity didn't ask the manager to divest?
So the mutual fund, if you ask them to divest and they do not, you can stay invested with them in a mutual fund. But if they make available an option of their mutual fund without those stocks in it, you have to move over to that other.
Right, and then what's the penalty if you don't move over from the state?
Well, the issue would be you'd be in violation of your investment policy guidelines.
Right, and
He's asking, what's the recourse that the state has against the board or whatever?
Well, you'd be in violation of your investment policy guidelines, so the extent to which they can find you in violation of your investment policy guidelines, they could come in and talk to you, they could withhold your money, they have kind of a broad range of things.
right, I mean, is it a criminal violation? Is it a civil violation?
It's not a criminal violation. So to be clear, the statute does not require you to adopt the provisions of not investing in companies that boycott Israel. What the statute says is you can be found to be boycotting Israel. And I can't tell you today that investing in Unilever enough to get you on the list. So that's why we're recommending that you follow the SBA's guidance on this. And, you know, actually the Florida legislature's guidance and the rules that they apply to the SBA. You are not mandated to do that.
I would propose we accept this, unless there's more discussion.
Just to confirm, then it's Mariner who has a responsibility to make sure we're in compliance and monitor.
Exactly, yeah, so every year that we have since 2010, we send these letters to every mutual fund that a Florida-based client has and say exactly, here's the list, divest, and if not, offer another fund, and if not, then, I mean, we don't say it, but then we're covering our bases from a legal perspective and allowing us to continue to maintain the investments that we have. But we have a paper trail for every one of our clients, for every fund that we invest in, doing this every year, yes.
And 100% of the mutual funds who have been asked to divest of the things on the list don't.
Yes.
For 15 years.
Any other questions from the board?
All right, so you have a motion put forward?
Yeah.
Okay, second.
I'll second that.
All in favor?
Aye.
All right.
All right. And that concludes your investment report for this quarter. Thank you.
Thank you, sir. Appreciate your time. All right, Bonnie, Board Attorney, go ahead.
Okay, so the first thing that I want to report to you on is related education. This is a United States Supreme Court that was just recently decided. I'm bringing it to you for a couple of reasons. First off, it's unusual for the United States Supreme Court to get involved in things that you'd be interested in, right? So this tangentially involves your disability processing, but it's also a case out of a Florida municipality, and it involves a Florida governmental worker, a firefighter. So a firefighter in the city of Sanford developed Parkinson's, and she was unable to continue to do her job. She had the opportunity to buy health insurance from the municipality when she left, but at the time that she left, the city only allowed people who were on disability retirement to buy it for 2 years. People who went out on normal retirements were able to buy it till they reached age 65. At the end of her 2-year period, she said, you discriminated against me, and it was because I'm disabled. And she filed a lawsuit under the Americans with Disabilities Act. The United States Supreme Court took the case and said, sorry, you filed under the wrong law. The Americans with Disabilities Act covers people who say, I can perform the functions of my job with or without a reasonable accommodation. But you're saying, I can't perform the functions of my job with or without a reasonable accommodation. And so you sued under the wrong law, so you lose. It's instructful, it gives us some direction, and literally like 3 weeks before the United States Supreme Court case came out, one of the funds that our firm represents had an individual who filed an Americans with Disabilities Act case saying, I'm able to perform my functions as a police officer with or without a reasonable accommodation, and filed a disability application saying, I can't perform the essential functions of my job with or without a reasonable accommodation. And so, you know, our board, without the guidance from the United States Supreme Court, said, well, you got to pick a lane, right? You can't maintain both of those, and so they put the disability application on file. So you know, this could actually be, you know, a circumstance that comes up before you. But it also was about the ability to buy the health insurance and kind of, you know, that discriminatory process, or whether it was discriminatory, that you could only buy it for 2 years if you were disabled, but you could buy it into retirement if you're not.
So was the issue that she wanted to get the medical benefits in retirement?
So there's a Florida statute, 1120801, that mandates that municipalities allow people to buy health insurance into their retirement at the full cost. It doesn't have to be subsidized. And so many retirees buy their health insurance from the municipality in their retirement.
Interesting.
So they reach Medicare age.
And could you tell me that statute one more time?
12.0801. The second item is, we have a reporting requirement that's due this year. We have a biennial requirement that we make a report of our decision-making in voting and adherence to the fiduciary standards. This is something that we first did in 2023. In 2023, we took your investment policy guidelines. We put a cover page on it, which indicated that you were submitting your report pursuant to the requirements of the Division of Retirement, that the investment policy guidelines govern the investments in fiduciary standards, and this is what you follow when you make your decisions to invest, that you amended your investment policy guidelines to follow the requirement that year that you would only make decisions based on pecuniary factors, that you wouldn't use any social, political, or ideological reasons to make investments or to select an investment manager, that you communicated that information to the managers, which we did in 2023, that you also indicated to the, and we do add them into any future contracts that you enter into with an investment manager. And that you communicated to the managers that they should use that in their proxy voting. Again, information we include in the contracts going forward. We filed that report in 2023. So I would say 95% of the pension plans in Florida filed this same type of report. We had 100% filing in 2023. We're expecting that to be the same. We didn't get any pushback or any questions from the Division of Retirement. They didn't give us any guidance.
Right, that was the one where you weren't sure what the report was supposed to look like.
Exactly. Thank you for remembering that. So anyway, we're going to do the same thing this year. Your administrator is well aware, and they will file it. They have already signed up to file it. So at the beginning of October, there was an email that went out just asking for each pension plan to have somebody to sign up to file. Your administrator did that. The portal will open, I think, November 13th, and it's due by December. So we'll make sure that all happens.
And we don't need to do anything individually.
You don't need to do anything individually.
Excellent.
That's all I have, unless you have questions.
No, great, thank you. Troy, Plan Administrator, go ahead.
So we're going to run through this stuff pretty quick. Update on the state monies. Last year for police, you received $114,243. This year the number is $100,032,343, an increase of $18,100.
I'm sorry, could you say that one more time?
Sure. Want the total numbers?
Yes, please.
Sure. Last year's number was $114,243. This year, you received $132,343, an increase of $18,100 for police. And for fire, we're going great.
And what was that for the fire?
Fire last year was $153,217. This year is $952. 203,952, an increase of $50,735. So that's the highest number that I've seen for the fire. That's a pretty significant increase.
Mm-hmm.
Any questions on that? year in a row, they have not increased the fee. It's the exact same fee for 3 years in a row, for $750. So if there's no questions about that, I look for a motion to approve paying the membership fee to FPBTA.
Do we have a motion to approve the membership?
I'll make a motion to approve.
I'll second that.
Okay. All in favor? Aye.
Aye.
Thank you. We'll get that paid. And as you know, with any kind of a actually, I guess not one coming up. So we'll move right down to the educational opportunities for FPBTA. Has a winter trustee school coming up February 1st through the 4th, Rose and Plaza Hotel in Orlando. The process for that is all you have to do is send me an email, indicate that you wish to go. I send that to our analyst who signs you up and then sends you directly back your approval to go and your process to pay for your hotel. You pay for your hotel on your own as well as your food, and we keep those tracked on the form that he or she sent you. Okay, so like I said, the only thing you need to do is send me an email saying I'd like to be signed up for the class. I'll take care of the rest of it. All right, if there's no other questions, then that's all I have for that. We can move down to the consent agenda, if that's all right.
Yes.
Okay, we'll just run through that. So the consent agenda is the invoices that are paid. We have nothing that's owed that we need to get signed off on, and also the fund activity report, which is all the money that's coming out of the fund for retirements and refunds, et cetera. So if there's no specific questions, look for a motion to approve the consent agenda as a whole.
Any specific questions about the consent agenda? All right, motion to approve.
Second it.
Oh, we need somebody to.
Are you making a motion?
No, we need
I'll make a
somebody-
motion to approve it.
All right, and a second? All right, all in favor?
Aye.
Perfect. Anything else, Troy? Fantastic. Last thing we have on here is trustees' reports, discussion, and action. Anything else you gentlemen need to bring up? The only thing that I would like to bring up, and I'm not sure exactly, as far as the pension and the drop statements, I know we had a conversation about this in the past, as far as the members were receiving, I believe, one per year. And we had talked about trying to see if there was a way to get quarterly statements, being that the numbers were already run, and I don't remember how we left off with that conversation.
They basically want statements more than once a year. Is that something that's in the negotiated thing, or is it something that? I don't know whether it was an increase in the fee as far as that goes. If that's going to be done quarterly, I would think it probably would be. So that may require a motion if there is going to be a fee increase.
So I think that that's something that we have to discuss and come back if you wanted to have a fee increase on that.
So who would, that would be with you,
Yeah.
to that conversation?
That fee, if there is going to be a fee increase, I can get that and send that out. We would take a motion, I would get, just as the chair, approve that.
Yeah.
Okay. So I'll get that and I'll have that for the next meeting. So we can approve that, and if so, I can already have that in the works, you know. I doubt it's too exorbitant, but it is one.
Right, I just remember, we talked about it before, and I don't know if we came to a conclusion.
I never specifically talking to Bonnie about it as far as it needing a motion, but if it is going to be a motion, then we'll have to do it formally with the dollar amount.
Sure.
So I'll get the dollar amount so we have it.
Perfect. Thank you very much. If nobody has anything else, our next meeting, Tuesday, January 27th, 2026, 2 p.m. Any issues there? All right, perfect. Meeting is adjourned.